From New York City for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Ferro. A lift to markets. Stocks indicated higher ahead of the open. Bonds getting a bid as well. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
We begin with the big issue, forecasting the Fed's next move.
I don't think there was really anything new in Chair Powell's testimony.
It was quite hawkish.
Even a 1% move was not out of the question.
It's going to be really difficult for the Fed to hike rates aggressively.
We should get prepared for recessionary pressure.
More pain to come in broader markets.
Financial conditions tightening.
If the Fed remains as aggressive, I think those recession risks rise.
Becoming increasingly amplified.
They will continue to hike rates aggressively in the short run.
You will have fast rate hikes.
The fear of a recession will remain there.
They are acutely aware that there is likely to be some pain to the economy.
Joining us now to discuss is J.P. Morgan's Monica DeCenso and Invesco's Alessio DeLongis. Monica, let's start with you. From what we've heard, are you starting to get a more concrete sense of a hard versus a soft landing?
We still believe there's a path for this to be a soft-ish landing, but clearly recession risks have increased. We acknowledge that. I think it's important to note that the market has acknowledged that. And so that plays in a lot to how we think about positioning from here.
Alessio, you still remain overweight risk, and it seems like people are getting more gloomy on one hand, and yet they're seeing the beginning of the next cycle on the other. How do you stack up your view based on what we've heard from Fed Chair Jay Powell and the increasing use of the R word?
Yes, it's a fluid situation where we believe at this stage the probability of a soft landing is much higher than a hard landing. And it's really about balancing risk in the portfolio. What is the right way to balance that risk? If we are heading into a slowdown, but not a recession, we think a better way to maintain risk exposure is to be underweight credit, for example, while maintaining some upside through equity markets. Because ultimately, credit investors, as you know very well, Lisa, credit investors sell a call option, sell that upside to equity investors. So in a global 60-40 portfolio, just for a reference point, maintaining an overweight risk stance through some upside through equity, underweight credit, particularly risky credit such as high yield or bank loans, could be a way to wait for this transition to take place. The likelihood of a meaningful slowdown is going up, and we don't think it is priced in.
All right. So that seems to be a feeling and a fear that we have in markets. We caught up with former New York Fed President Bill Dudley on this issue of recession yesterday. Take a listen.
You really get a deep downturn when things in the financial system break and the ability to supply credit to people becomes impaired. I don't expect that to happen this time. So I would expect a mild recession like 1990 or 2001, not a deep recession like 73, 74, or, of course, the great financial crisis.
And Monica, Bill seemed to really underscore what both of you are saying, this sort of mild recession case as sort of the increasing base case. Is there anywhere that it's been overpriced, the idea of recession, or do we basically have a market, Monica, that is agreeing with you and right now a mild recession is consensus?
I think clearly the market believes we're either in a recession or we'll be in one shortly. That's clear, right? Down 20%. But the challenge now is you look at how tight correlations have been, and you expect to start seeing more dispersion again. And I think that's the opportunity. The question remains, where do I want to get access now? Where do I see value, for example, going into year end, where there's still levers to pull in the equity market, and people are just so defensively positioned that I think that creates the opportunity in pockets like energy and even parts of healthcare to add some risk in an intelligent way, acknowledging that we're probably not at the bottom, but we feel much closer to the bottom in our view in a mild recessionary scenario.
Monica, is that largely risk in equities, or do you also see risk in credit, kind of like what Alessio was talking about?
I think Alessio is spot on. Like, you don't need to take a ton of risk and go really far out to really risky things right now. You're getting paid in core fixed income. So why wouldn't I allocate a little more there? An asset class that hasn't made sense over the last 5 to 10 years suddenly is more interesting. And I do believe going forward will provide a better balance to portfolios than it did for the first 6 months of the year.
Chair Powell weighing in on the possibility of an economic recession. Take a listen.
It's not our intended outcome at all, but it's certainly a possibility. And frankly, the events of the last few months around the world have made it more difficult for us to achieve what we want, which is 2% inflation and still a strong labor market.
We got more data. We're getting even more. Here's Bloomberg's Michael McKee with a closer look. Mike.
Well, Lisa, the question is, are we in recession now? Are we going into recession later, or can the Fed thread the needle? The data right now suggests nothing on the horizon is imminent. You take a look at existing home sales, which we got last week. They are down. And of course, that's what you'd expect when mortgage rates are going up. You can see the red line there is when the Fed first raised interest rates. But it's that blue line that we're really paying attention to here. That's jobless claims went down last week by 3,000. They've elevated a little bit, but they're still staying in roughly the same range. So it doesn't look like the labor market is weakening yet. That's the thing to keep in mind. We have a number of economic data points coming up over the next week or so that we want to keep an eye on. And these are not just the traditional ones, but these are the ones that are going to be, as that last graphic had it, the recession Rorschach. We're going to take a look at jobless claims every week. Friday, Michigan inflation expectations. That's what drove the Fed to a 75 basis point move last week. And we get an update on that tomorrow. New home prices. We know sales are weak, but are prices going to start coming down because they keep adding to inflation? On next week, on the 27th, we get the capital goods orders. Are businesses cutting back at all? Conference board expectations. This is an interesting one because it's tied to the job market much more than the Michigan numbers. So if the job market's weakening, that's what will give us a clue. And then, of course, consumer spending next week. The retail sales numbers just give us goods, basically. The spending on services will come in this report, and that will be a key number for the Fed to watch. As we watch Jay Powell today, we haven't heard a whole lot new from him. How far and how fast do rates rise? Maybe he'll give us a little more on that. How much and how quickly does the economy slow? He says they hope it doesn't slow too much. And how will the Fed know whether it's gone too far? That may be the key question left, Lisa.
Michael McKee, thank you so much. And at 10 a.m., we do get, of course, the testimony from Fed Chair Jay Powell, day 2 on Capitol Hill. Monica DeCenso and Alessio DeLongis still with us. Alessio, I want to dig in a little bit to your call about leaning into risk. And you view that largely through the equity markets, but you're also starting to lean into credit. We're talking about the R word, and we're not talking about an increase, a dramatic increase in defaults. Do you think that we have overpriced a default cycle that has basically been killed by the locking in of longer-term maturities and a Fed that will eventually step in to the rescue if there is true disruption?
No, the situation is fairly fluid. My point with the view on credit is that if you look at high-quality credit where you can start to harvest 5% yields, which we haven't seen in a generation, it certainly argues for beginning to reposition for this more supportive environment for harvesting yield in the low segment, in the high quality parts of the market, primarily because you're really sourcing duration there and defensiveness. When you look at the risky parts of credit markets, I think there is more of a concern where recession risk is now priced. Like, Monica mentioned something earlier. There are several metrics that we can point to suggest that a recession is priced, but let me provide an example. Equity markets are down about 25% year to date, just in line with the underperformance of 30-year government bonds. Now, equity markets are a long duration asset. What is that telling us? Is telling us that equities have just repriced the rising discount yields. Equities have just derated their valuations because of tighter monetary policy. But we haven't necessarily seen the typical recessionary dislocations, be it freezing in risky credit markets, underperformance of EM overdeveloped, or small and mid caps over large caps. We are not seeing those typical recession dynamics. And to go back to your earlier question, Lisa, that's where we believe that in and of itself, a recession is not priced through the default cycle. And we don't think that the Fed is going to necessarily come in and rescue the day as we have seen in the past.
And to sort of build on this point, some people would argue that we're not really out of the low rate regime. We're just taking a pause. And Paul Krugman of the New York Times wrote a column to that effect. HSBC's Stephen Major, I'm sure, agrees. He weighed in on the peak of the U.S. rate cycle. Take a listen.
The Fed is well served by keeping some hawkishness there, because if they appear that they've reached the peak, then financial conditions will loosen and the policy won't work. So that they need a couple more months of this, and I think that by maybe August, September, it's time for the formal shift to take place. The markets are smelling it already.
And Monica, perhaps the markets are smelling it in the rally that we're seeing across the board in U.S. government bonds, but particularly on the short end of the curve. How much do you buy into duration? How much do you buy into this idea that the Fed will basically prove to be a head fake in terms of how much they're going to hike rates?
I'm hesitant to say head fake, but I do think it's fair to assume that they're going to be nimble. They want to do the right thing and try to guide this as best they can. And so for us, observing markets, the challenge is, going back to the earlier points, how much is priced in? What's the risk reward here? And if we are in a recession and they can't prevent that, how much more weakness is there to come? And again, it does feel like we've priced in a large amount of it, which is why I'm comfortable taking a little bit of risk on the equity side and even, adding a little bit on fixed income again. I don't think you need to stretch, but on the core side, if you can make 4 or 5%, that feels like a no-brainer.
Well, and Alessio, do these stories go together? Is the bid into duration what's underpinning the bid into equities, because people do not believe that there's going to be runaway inflation and a bond bear market that continues to experience pain?
It is sort of the right compromise. When you look at what is priced in for Q1 of next year, the Fed funds is priced in at 3.5. Obviously, we have experienced that kind of rapid move thus far, and we've been proven wrong. So it's certainly possible. But if you believe that the economy is slowing, beginning to lengthen duration and or add more to a higher quality fixed income relative to risky fixed income or equities, it is possible. And the way to make it consistent is, for example, to begin to move into defensive equity sectors and defensive equity factors such as quality over value or large over size. What we have seen year to date has been an outperformance of cyclical sectors, ironically enough, because they've been lifted by the rise in discount yield. So the pricing of the typical cycle this time around has not worked out, because markets have been predominantly driven by a repricing of yields rather than a repricing of cash flows. So to Monica's point, if the economy is soft landing and not going into a recession, you can be both overweight equities and overweight duration. That is sort of where this can work out, assuming we avoid a recession.
Revenge of the 60-40. Monica DeCenso and Alessio DeLongis, both of you sticking with us. Joining us now with a look at the stocks moving ahead of the opening bell. Here's Abigail Dullo.
Well, Lisa, we're certainly looking at a firmer open for stocks. The S&P 500 E-mini futures off the highs, but up about 0.5%. This means that big tech is higher. In fact, if you take a look at the NASDAQ 100 futures, up even more. Apple up about 1%, heading to a third out of fourth days. This is yields are in. And even though that could be a haven bid, it, of course, takes valuation pressures off of the big tech and the growthier names. Amazon heading to a fourth up day in a row. The first time we'll have seen that in about a month if it holds to the close. And we know anything is possible. Alibaba really outperforming, up 4% on the hopes that the Ant Financial Group will go public relatively soon. Plus tailwinds over there overall with the Hong Kong HSI doing pretty well. And then Occidental Petroleum. Oil may be down a little bit, but Occidental Petroleum up about 3%. This on the news that Warren Buffett's Berkshire Hathaway has added another 9.6 million shares. Investors seem to like it. Again, Occidental Petroleum strong, up 3%, Lisa.
Abigail, thank you so much. Coming up, President Biden asking Congress to help with gasoline prices.
By suspending the 18-cent gas tax, federal gas tax, for the next 90 days, we can bring down the price of gas and give families just a little bit of relief.
That conversation coming up next. What we're seeing in the markets is a rally that is building as we head toward the open, about 17 minutes away. The S&P up 0.6%. This is Bloomberg.
There's really not anything that we can do about oil prices. There's a little, food prices is a bit more mixed, but for oil prices, they're set at the global level. It has to do with with global oil prices and also the refining spread. Neither of these are things that we have the tools to affect.
With the Fed offering little help and perhaps having little power to do anything to address the real issues, President Biden turning to Congress calling for a suspension of the federal gas tax.
By suspending the 18-cent gas tax, federal gas tax, for the next 90 days, we can bring down the price of gas and give families just a little bit of relief. I call on the companies to pass this along, every penny of this 18-cent reduction to the consumers. There's no time now for profiteering.
Bloomberg's Anne-Marie Hordern joins us more from D.C. Anne-Marie, this was widely panned before it even came out. Was the reception different than what it was before he gave that speech?
Not really. We did hear from Speaker Pelosi out with a statement, and she said we're going to see where consensus lies on the gasoline tax pause. So, Lisa, that says to me that even Speaker Pelosi is still quite concerned and has some questions regarding what a gas tax holiday would actually achieve, because she's going to see where consensus lies. She's not even saying she's willing to bring it to a vote. She's just going to have a conversation about it. But today we should hear more about potentially any sort of dialogue moving forward between the industry and the administration when Energy Secretary Granholm will be sitting down with some of those executives that President Biden sent that letter to. But you heard it here from the State Department's senior advisor on energy security, Amos Hochstein. He says that he has been in talks with the industry, and there's nothing they need in terms of U.S. policy. What they do need is, in his terms, are bankers in New York and investors to tell them to use this money that they're making from record profits, where the price of oil is trading right now, and invest it back to production and refineries.
Anne-Marie, of course, that will take time, which is one of the key concerns for some looking at the tightness in the oil market. Anne-Marie Hordern in Washington, D.C., thank you so much. Still with us, Monica DeCenso and Alessio DeLongis. And Monica, from your perspective, looking at oil and the wild ride that it's been on over the past 48 hours, do you think people are starting to understand that perhaps there will be less demand than they previously expected because of demand destruction in the face of $5 a gallon?
It seems very clear that's what's been happening, less that there's been some quick fix to the structural issues that caused energy prices to rise in the first place. The biggest risk to our bullish view on energy and on commodities in general is real demand destruction from the deeper recession. Still, though, in a mild recessionary scenario, I think you're still looking at a world where energy prices are elevated. And I think that's the struggle that you're hearing about, from the president, that there's not an easy way to solve this near term.
And that bear case was really represented by Citigroup's Ed Morris, expecting crude prices to eventually make their way back down into the 80s, writing, quote, given the strong headwinds to growth resulting from both higher prices of commodities and central bank actions, we project a trend line downward in prices through 2023 and in all likelihood beyond. Alessio, where do you stand on this, considering it is a contrarian view? It doesn't necessarily take into account the tightness that some people are saying, and his view is that we are overestimating demand. Do you agree?
What they're basically calling for is a return to the old relationships where growth and demand dominate supply considerations in the setting of prices of commodities. And I think it's perfectly consistent with what the Fed is trying to achieve, right? So on the margin, I tend to agree with that view and the rationale for that view. The timing obviously may be off, but the rationale makes perfect sense. If on the margin, the news flow on the supply side bearing major exogenous shocks, that news flow is receding. And the real news flow now is on the demand side, where the Fed has taken control of the rate of change. So rising inventories and an oil curve that goes back into contango is what you want to see as a proof that mechanism is taking place.
Alessio, have you started to fade energy stocks in the face of the potential for this demand destruction?
Yes, the move, the positioning that would be consistent with that is something along the lines of what we discussed earlier, right? A rotation out of cyclicals into defensive, so out of energy, industrials, materials, out of value sectors into quality-oriented sectors, which also would mean communication services and technology, right? If yields peak here, and now the innovation is on this re-rating down of cash flows, cash flow growth expectations coming down, That's the rotation from value to quality or from cyclical sectors into defensive sectors.
Monica, what about you? Have you also started to reduce your allocation to energy? I know you are overweight energy or do like that space because of this idea that of a soft landing and not necessarily the depth of the recession that is the bear case.
I think generally speaking, you want to be more cautious on cyclicals going into a recessionary time, clearly. That said, even at $80, $90 a barrel, there's still a lot of energy names, especially on the U.S. side, that could work going into next year. And so that's where we're sort of threading the needle on the energy call, that we still see upside for plenty of these names in the U.S., and that's fine, but that doesn't mean you have to be overweight cyclicals in general. Broadly speaking, clearly want to be more defensively positioned, but there's pockets, oil field services, other parts of energy that probably still work.
So, Monica, are you buying into the weakness that we've seen in oil majors over the past couple of trading sessions?
We have seen actually profit taking in recent weeks, but if this dip were to continue, we see another 5 to 10% lower, absolutely. That said, you've seen positioning. I think people have been bullish, but bear in mind, allocations overall to the energy sector are still very low versus where they used to be because of the destruction of wealth that happened over the last 10 years because of the end of that commodity super cycle.
My thanks to Alessio De Longis for being with us today. Monica DeCenso, you're sticking with us. Coming up, the morning calls and later recession fears dominating markets. We'll discuss with Samir Samana of Wells Fargo. That conversation still ahead. We are trying to retrace some of the losses of last week. The S&P building into the open, up 0.7%. From New York, this is Bloomberg. This is Countdown to the Open. I'm Lisa Abramowicz in for Jonathan Ferro, taking a quick look at the rally that is building ahead of the Open as we see NASDAQ futures up about 1%, S&P up 0.7%. That bid into bonds perhaps underpinning of it. Across of the yield spectrum, we can see 10-year yields now almost down to 3.07%. How much do we get a continued bid as people say perhaps the Fed will not be able to go as quickly as they are talking it up? Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, JP Morgan upgrading Funko to overweight, seeing upside to consensus estimates with toy companies showing resilience during recessions. Next up, Raymond James upgrading Southwest Airlines to a strong buy, pointing to an attractive valuation following recent declines. And finally, Morgan Stanley resuming coverage on eBay with a street low $36 price target, expecting market share losses to drive weaker top-line results. Coming up, futures pointing to a rebound with stocks looking to snap their 3-week losing streak. That conversation coming up next with Samir Samana of Wells Fargo. This is Bloomberg. This is Countdown to the Open. I'm Lisa Abramowicz in for Jonathan Ferro. Moments away from the start of trading, and we do see that rally as we see the NASDAQ up 0.9%. The S&P at 37.84. The bid into bonds getting my attention, even as you have a Federal Reserve Chair on Capitol Hill talking about how a recession is not out of the picture. You see yields lower, bonds prices up 3.07% on the 10-year. Crude getting a little bit of a lift after having earlier been down on recession fears. Dollar strength coming through with 105 on the euro-dollar cross. Joining us now with a look at the stocks moving at the opening bell, here's Abigail Doolittle. Abby.
Well, Lisa, certainly a bullish tone here on the open. And one stock that's outperforming, participating, Occidental Petroleum, not so much because of oil, but because of Berkshire Hathaway. Warren Buffett's firm is adding to its stake, 9.6 million shares. They are the top holder of the company, owning about 17% of Occidental Petroleum. KB Home really bucking the bearish trend that we've been hearing about recently in housing, up 5.2%. This after they put up a solid beat and they raised the outlook slightly. Darden Restaurants had been higher earlier. It's still up a little bit, up about 0.5%, but they put up a good quarter. A modest beat does ease some inflation fears, both in terms of how the company handled it and diners dining out. And then finally, Lisa, we do again have mainly a bullish tone this morning, but the commodity complex is slumping for a second time. Freeport-McMoRan down about 5% over the last 2 days. Right now down about more than 2%. This, of course, as copper is slumping over the last 2 days. Another tell on the global economy and perhaps fears around a recession.
Abigail, thank you so much. Let's turn now to San Francisco, where Bloomberg's Ed Ludlow joins us for a look at how big tech is trading at the opening bell. Ed.
Yeah, good morning, Lisa. We're up on the NASDAQ 100, a percentage point. Look at names like Apple really pushing the index higher. Apple up more than 1.3%, taking its crown back as the world's most valuable company from Saudi Aramco. Of course, Saudi Aramco being weighed on by the moves in oil in recent days, those two sectors kind of moving in opposite directions. You'll see Microsoft a big gainer. Robinhood rebounding big time, up 6.8%. There was news yesterday that Binance, a big rival, would start offering fee-free trades, which weighed on some of its platform peers. And you'll see Alibaba up around 5 percentage points. This story that policy support in China is growing. PBOC giving Ant Group, for example, potential approval to become a financial holding company supportive of that sector. You look at this chart on the Bloomberg terminal, and we ask the question every single day at the moment, has tech bottomed out? I'm looking at a number of things. You look at NASDAQ 100 E-mini futures for September, up in 3 of the last 4 days. You look at the number of names on the S&P 500 information technology sector index that are trading above their 200-day moving average, very small. And I know you've had this conversation last week, right, with Scott Minerd of Guggenheim. You hear Mark Mobius adding to this call that he's looking at Bitcoin as kind of a leading indicator for risk assets. If we see a bottom in Bitcoin, will we see a bottom in the equity markets? That's one space we're looking at. The other conversation we're having is a global one. On the closing bell yesterday, we were talking about the Fed exporting inflation and the psychology around the technology sector globally. Differences in markets. You look at the Hang Seng, China, a really good month. The S&P 500 in the tech sector still having a bad month in the month of June, and the Stock 600 in Europe down even further. There's no consistency across tech globally, and you do wonder how big that yield story and how big that rate story will continue to be for this sector.
And I'm glad that you mentioned that. Ed Ludlow, thank you so much. How much is big tech ultimately a rate story and a proxy on whether yields are going down or up? Now turning to the banks, the Federal Reserve releasing its bank stress tests results later today. Joining us now, Sonali Basak. Sonali.
You have really interesting scenarios this year, Lisa. You do have commodity shocks being priced in this year, as well as public equity and RMBS shocks. And you are already seeing some of that, obviously. Another thing the Fed will be looking for the banks is counterparty risks. So what would happen if their largest counterparty had failed? Again, some of these risks we got dangerously close to in a lot of different ways in the last year or so. But when it comes to the scenarios themselves and whether the banks actually pass, the question, of course, coming out at the end of the scenario testing is the buyback and dividend plan. You have the capital return plan. The banks expected, the large five, expected to give about $80 billion back to shareholders. JP Morgan being the largest, of course, expected to come in with the most, $18.9 billion worth of buybacks and dividends, according to estimates of Bloomberg and Barclays. Bank of America and Wells Fargo, each with more than $15 billion. I must also say, though, a lot of these banks have also guided that the macro environment is getting tougher. They are going to be taking a moderated approach to buybacks. You heard that from the likes of Citigroup, and it's also from Goldman Sachs, for example, where John Waldron just recently told investors that they were making such a good return on equity in their business that they would prefer to use capital in that fashion. So the numbers compared to what investors expect will be very interesting to watch this time around, given volatility is still soaring, and given the banks will want to put money to work in that fashion, as well as lending in this tough environment as well, Lisa.
Sonali Basak, thank you so much. Samir Samana of Wells Fargo Investment Institute joins us now, alongside JP Morgan's Monica DeCenso is still with us. Samir, I'd love to get your view, actually starting on the banks, because they've been so beaten up. Originally, people thought that they would benefit as rates rose. Now the concern is they're going to really suffer in the face of a slowdown in lending if there is some sort of recession. What's your view?
Yeah, I mean, look, it's all about the curve, right? I mean, if the Fed's going to treat 75 as the new 25, that curve's going to flatten pretty quickly. And it's probably only a matter of time before it inverts. That's probably a second half of 2022 story. So, we recently downgraded financials. We played them when the curve was steepening, but, with the curve flattening as fast as it is, we want to be neutral on financials. They are still cheap, especially those bigger banks, but we just see better opportunities in areas like energy, healthcare, and technology.
Monica, what about you?
Yep. As I mentioned earlier, I think you still need to question cyclicals in general. You want to be a little more cautious there going into a slower economy. And the comment, as I mentioned earlier, energy, still like pockets there. Healthcare, I think, is really interesting because we're going into an election cycle. And for the first time in many cycles, there's not as much concern about regulatory reform. And that could be an opportunity in that space.
Samir, on a broader level, we're looking at a changing market where suddenly people are talking about the R word a lot more. You also have a base case as a soft recession or a shallow recession. Are we already there?
So, that was a call we put out a few weeks ago, and, we were at a consensus then. The consensus is quickly moving towards us, and unfortunately, the way we're seeing the data evolve, we're now considering, at what point it's maybe a longer and deeper recession. So, yeah, I mean, it's probably coming in the second half, a shallow recession. Again, the question will be the duration and the magnitude. The right way for investors to position is by pulling back on risk. Even here, we're not that far off the all-time highs. I appreciate that we've had a little bit of a bear market, but we had quite the overshoot. So we haven't pulling back on, more cyclical areas like small caps, emerging markets. I mentioned financials, industrials, comm services, discretionary. It's still not too late to try and get, your position for kind of wealth preservation, for the second half.
What the interesting thing is, Samir, and this is something that Goldman Sachs' Jan Hatzius has put out, talking about how recession is more front-loaded, increasingly concerned the Fed will feel compelled to respond forcefully to high headline inflation and consumer inflation expectations if energy prices rise further, even if activity slows sharply. Samir, could we get a quicker turnaround? I mean, how do you position? I know this is maybe premature, but the next edge of the cycle and getting in on consumer cyclicals or things that are more sensitive to a new economic cycle.
I think you got to be very careful with that. I mean, again, I think the Fed's got to acknowledge their role in causing inflation in the first place, which is they went kind of gangbusters with respect to fighting the downturn, both with rate cuts, buying assets, then we had fiscal stimulus kind of on top of that. So I think even if there was a recession, if they're still fighting inflation, I think the Fed's going to be very reticent to have big rate cuts. And then I think they have to acknowledge that, look, if they do, try to do too much to soften the next economic recession, that inflation could come back faster than they expect. And, that's kind of what we fought in the 70s and 80s is you just kept having higher and higher lows and higher highs in inflation until the Fed finally got real.
Well, certainly the market is treating the recession risk as real. The S&P down 21% this year. The last time the index saw such drop was in the first half of 1970s. That was the first time we saw the first half suffer this much. Let's bring in Taylor Riggs for more. Taylor.
Yeah, Lisa, and really putting that into perspective. And I think what's interesting, Deutsche Bank, I think 2 days ago had a great note out on this, that this really is one of the more painful starts to a year. We still have about one more week or so until we get to the first half. But so far, barring a huge, massive reversal, this is really going to be one of the worst starts that we've had, particularly when you adjust for inflation. And typically, as we know, stocks have sort of been the bellwether to keep up with inflation. And this time, that really hasn't played out. I think what is interesting, and we always try to be forward-looking on this program, that after some massive declines in the first half, historically, what happens in the second half? Do you get a total washout and you get a little bit of a rebound? Interestingly, you can. After some of these previous years, and we've looked at when the S&P has lost at least 7% or more in the first half. After that, like the 70s, as you can see there, a little bit in 82, and then, of course, in 2010, after a big washout in 08 and 09, equities have performed pretty well in the second half of the year. I think what is sort of maybe different this time around, though this sounds eerily similar to maybe 2099, is it really has been those big tech stocks, Lisa, right? Because this hasn't really been an equity washout. It has been a refocus on higher yields and what a higher discount rate means for present value. Well, one way we can show this, if you will, and feel free to jump in here, Lisa, is the equal weight's the big outperformer. Growth is the massive underperformer relative to value. That really shows the yield story.
Taylor Riggs, thank you so much. The returns that we've seen, highly negative. Monica DeCenso and Samir Samana both still with us. Monica, how much of margin compressions have we been pricing in, and how much of a downside surprise could we be vulnerable to as the second quarter earnings start trickling out?
I think it's pretty widely viewed that second quarter earnings won't be great. And I think that's reflected to a fair amount in the 20% plus drawdown we've seen. So now the question becomes, how do you think about positioning going into the back half of the year? You saw those stats of how snapbacks have looked in the past. While I don't think this is an 08-like recession, I do want to be cautious that I don't think this will be a COVID-like snapback either. We do think it makes sense to take risk in an appropriate way in pockets where we see possibility for outperformance. Again, thinking about areas in energy and healthcare, maybe even China if we see reopening faster than anticipated. But I just think it's too soon. You still have a few data points coming, Q2 earnings. the Fed kind of digesting more information over the summer before I think you'll start to see the data get easier. Markets are always going to bottom, though, before the data clarifies. So just bear in mind that.
Samir, I'm not trying to get you in trouble, but I've been seeing all of these studies showing that analysts of individual stocks have lagged behind the revisions that we've seen in just price dramatically this year. It's been one of the biggest differentials that we've seen going back to 2000. Do you take anything from some of these analysts' reports as gospel, or do you actually view them more as just sort of a benchmark to understand consensus?
Yeah, I mean, look, consensus is way behind, and earnings are the next shoe to drop. I mean, to your point, look, if revenues are slowing much, much faster than costs are, I mean, margins are probably still, as far as assumptions go, much too high. So we do think that's the next shoe to drop, and we think earnings for probably both 22 and 23 have to come down. And, where those earnings estimates go probably, kind of then leads back to where the market's bottom. Now, I will say, look, in the mid 3,000s, call it around 3,500 or so on the S&P, if we get there, you're getting paid to take the risk with a pretty high level of uncertainty. So at that point, maybe we start to look a little bit through, whether the earnings shoe has dropped or not. But at least here, I think that's the biggest risk to markets is that earnings, at least the biggest, downdrafts from, estimates, assumptions is still to come in the future.
Our thanks to Monica DeCenso, Samir Samana. You're sticking with us. Coming up, recession fears keeping markets on an edge.
In the U.S. case, I think it's quite likely you have a recession. Given the extent of the inflation, the strength of the labour market, the Fed needs to slow the economy, needs to get unemployment up in effect.
And the latest tea leaf is incoming just a few minutes away from another piece of data. That's next from New York. This is Bloomberg. This is Bloomberg Markets, The Open. We do have some data breaking on the terminal. Another downside surprise. Here is our own Michael McKee. Mike.
Yeah, it's the S&P PMIs, the Purchasing Managers Indexes. These are smaller companies than in the ISM report in general, but still representative. And they have all come in weaker than expected, significantly a downturn in manufacturing from 57 to 52.4. The services PMI falls to 51.6 from 53.4. And the composite PMI is 51.2 after 53.6. Now, this parallels what we got from Europe today, which was pretty similar declines. Nobody going into contraction territory, but we are seeing numbers like Germany on their composite falling to 51.3 from 53.7. The French are down. The Eurozone as a whole falls to 51.9 from 54.8. And in the UK, they were the winner of the day. Theirs is unchanged at 53.1. But these are all just barely the numbers that you need to see to show expansion. And Lisa, it does suggest that the global economy is cooling. I would go beyond just the manufacturing and look at those services numbers. That's what everybody's going to be keeping an eye on.
Yeah, this was the sector that was supposed to be rebounding as we did reopen. Michael McKee, thank you so much. I do want to just point out that two-year yields take another leg lower, now firmly below 3%, 2.94%. We are looking at as we get some of these disappointments. And as Michael said, they do track what we saw over in Europe overnight. 10-year yields sticky. It really is a question of how far the Fed will be willing to go. Back with us, Samir Samana of Wells Fargo Investment Institute, which really goes to the question of whether we're already seeing some sort of downturn in the economy and whether this gives the Fed a reprieve. What's your view, especially given the bid into the front end?
Given that the Fed's kind of been cut off sides with this transitory narrative once already, it's going to be hard for them to pivot now back to the economy. So until inflation comes down, I think they're probably a little bit stuck, even if there is a slowdown and even if unemployment does start to tick back up. So, that really is kind of the risk to, kind of the economy and markets that we've been throwing out there, which is, look, if you have a Fed focused on inflation while things are slowing, we just haven't had that combination in a long time. And history tells you that it doesn't end well. So, that's why we are calling for a shallow recession. And, the risk, if anything, is to the downside. And we think, the way for investors to position right now is to move up in quality, move up in market cap, focus on the U.S. We have a little bit of a barbell on the sector side where we like energy, tech, and healthcare. That's because we're still kind of in the the latter stages of this, economic, upswing. But eventually, if anything, we'll probably get a little bit more defensive and a little less cyclical. And it's not surprising today that your top 3 or 4 sectors are utilities, healthcare, staples, and REITs. It's a very typical defensive recessionary playbook.
And Morgan Stanley's Mike Wilson with with 2 paths out of this market, quote, the bear market will not be over until recession arrives or the risk of one is extinguished. How much, Samir, are we looking at the dollar remaining the haven bid and remaining the ongoing risk-off trade as we do get this kind of environment without the risk of recession taken off the table yet?
Yeah, I mean, look, the dollar's one of the cleanest trades out there because history tells you that it's almost always a safe haven, during downturns. And this time around, we also have rate differentials working for us as well as growth differentials working for us. So for all those different reasons, if anything, the dollar has, more kind of, boosters this time around than it has during previous downturns. And, kind of to Mike's point, I guess with respect to, until recession, is extinguished, I mean, I would say, it's not over until inflation's extinguished. So, really, again, I think that's the part we have to think differently about this time around.
So right now, when we see the dollar, it's actually losing a little bit. We are still seeing that bid into bonds. Where are you taking some risk and duration? I say risk because we saw the risk of the first half of the year in terms of what total return was. But where are you taking risk in the safer spheres of the fixed income market?
Sure. So we actually recently took the opportunity to go neutral on long-term duration. We've been most unfavorable for the last year or so as rates, kind of ticked higher. So, I think that was a pretty good move. Just again, from the standpoint of bonds do have a role to play in portfolios. And at these yields, it does make sense to be at least neutral. We like higher quality credit. This is not the time to be extending down the credit quality curve. So we recently downgraded high yield. Again, we still think there's time to up the quality in your bond portfolio. We, from a fixed income standpoint, have mainly been playing kind of defense as opposed to offense, just because you do have rates rising. But we also took the opportunity to raise the rating on short term. Again, with those short term rates rising as quickly as they are, with 75 kind of the new 25, we think some of the income that we had been stretching into the intermediate part of the curve for, we can now get on the short term side. So we up short term, we up long term, we downgraded intermediate just because there's a little bit more opportunity on those tails of the curve.
Samir, can you just put into perspective how defensive you are right now versus, say, 3 months ago, considering that some people are starting to view the next cycle as upcoming and they're starting to invest as such?
Sure. So kind of at a high level, if we were call it 105 to 110% of our risk budget, as recently as 3 or 4 months ago, we're now probably in the mid 90s. So it's been quite the turn. And again, a lot of it has to do with, I think there were expectations that inflation would at least level off. We were not in the camp that inflation would necessarily come back down quickly, but we at least hope for it to level off. But the fact that it was still accelerating at the last reading, that's really what's changed in the last few months. And, the other thing that's really changed is going from, again, 50 was a real debate. And now that they've moved on to 75 after taking it off the table just months ago, just shows, how much of a, tricky spot the Fed's in.
Before we let you go, Samir, how important is tomorrow's University of Michigan sentiment survey?
Sentiment's a lagging indicator, especially consumer sentiment. We can already see that the consumer's stressed, right? I mean, they're taking out loads of debt. Their mix at retailers is all about staples and groceries as opposed to apparel and, retail. So, I mean, again, the consumer's stressed. I wouldn't focus so much on that number. I think the bigger thing is going to be, watch oil, watch commodities. If they can keep coming back down, that'll take some of the pressure off the Fed going into July.
Samir Samana, thank you so much for being with us. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. In the markets, you are seeing the rally fade just a touch as we head deeper into the open here. We see the S&P now just clawing onto gains up 0.1% after that disappointing number from the PMIs, just following on to what we saw over in Europe. This is Bloomberg. This is Bloomberg's The Open. I'm Lisa Abramowicz in for Jonathan Farrow. That PMI report that was disappointing, really sinking a hole in markets. The Nasdaq turning negative at one point, now up at 0.2%. The S&P up 0.3%. If you look over the bond space, things going pretty wild on the 2-year, sub 2.9% at one point, as yields do continue to drop on the heels of that. 10-year yields now 3.047% if you take it out a bunch of digits, as Tom Keene would like to do. Time now for the trading diary, what you need to be watching this week. Chair Powell on Capitol Hill for day 2 of testimony at the top of the hour. The Fed releasing the results from its stress test at 4:30 p.m. The Department of Energy holding a meeting with oil executives today. More Fed speak from Presidents Jim Bullard and Mary Daly on Friday. And finally, new home sales and the University of Michigan Consumer Sentiment Survey to close out the week. This was Countdown to the Open. This is Bloomberg.